Autobiography of Benjamin Graham, architect of value investing and master of market strategies. Benjamin Graham's life story is not only a window into the man who revolutionized investing, but also a testament to the discipline, intellect, and rigor that underpinned his approach to markets. Known as the father of value investing, Graham is best known for his legendary book, The Intelligent Investor, and for training generations of investors in a strategy that stresses the careful analysis of securities, a skeptical view of market behavior, and a margin of safety to protect investments. His autobiography would reveal not just his insights into value investing, but his methods and market strategies honed over decades on Wall Street. Early years, the foundations of Graham's analytical mind. Benjamin Graham was born as Benjamin Grossbaum in London in 1894. His family moved to New York when he was still young, and while his father passed away soon after their arrival, Graham's mother worked hard to provide for the family. These challenging times left a lasting impression on Graham, cultivating his desire for financial security and instilling a deep caution regarding money management. Despite his family's financial struggles, Graham excelled academically and received a scholarship to Columbia University, where he graduated among the top of his class. His academic excellence drew the attention of multiple departments that wanted to keep him as a professor. However, he chose instead to pursue a career on Wall Street, where he would make his mark not just as an investor, but as a thinker whose ideas would transform finance. The early Wall Street years, the genesis of value investing. Graham started his career on Wall Street in 1914, during a time of significant financial uncertainty and economic volatility. He quickly gained respect for his analytical skills and innovative ideas about market valuation. By his late 20s, he had become a partner at his firm. But it was during the 1920s, a decade of both great opportunity and great risk, that Graham developed his groundbreaking value investing approach. The market crash of 1929 had a profound effect on Graham. Having experienced firsthand the devastation of the Great Depression, he became more determined than ever to create a method of investing that minimized risks for individual investors. This led to the foundation of what would become known as value investing, a strategy focused on identifying undervalued stocks with sound fundamentals to mitigate risk and secure a margin of safety. Graham's value investing strategy, the birth of the margin of safety. One of Graham's most notable contributions to finance is his concept of the margin of safety. He believed that investors should buy stocks at prices well below their intrinsic value, thus creating a buffer against potential declines. This concept became the cornerstone of Graham's investment philosophy, distinguishing it from more speculative approaches prevalent at the time. His autobiography would no doubt detail how he tested and refined this principle through market booms and busts, ensuring that it could withstand different economic environments. In 1934, Graham co-authored Security Analysis with David Dodd, a fellow professor at Columbia University. This book laid out the foundation of value investing in exhaustive detail, covering techniques for analyzing financial statements, assessing business fundamentals, and valuing stocks and bonds. It provided investors with a toolkit for analyzing securities based on intrinsic worth rather than speculative value. Graham's security analysis went on to become a classic, inspiring generations of finance professionals to invest not on hype but on solid business data and financial health. Stock selection and arbitrage. Graham's unique market strategies. Throughout his career, Graham developed a number of strategies to exploit market inefficiencies. These strategies went beyond traditional stock selection and included several innovative approaches. 1. Intrinsic value analysis. Graham's approach was to calculate the intrinsic value of a company based on fundamental analysis taking into account assets, earnings, and financial stability. If the stock price was significantly below this intrinsic value, Graham would consider it a buy, allowing for a margin of safety. This rigorous approach ensured he invested only in companies that were financially sound and undervalued by the market. 2. Arbitrage opportunities. Graham was also skilled in identifying arbitrage opportunities, particularly in situations involving mergers, liquidations, and other corporate actions. For instance, he would buy stocks in companies undergoing mergers or acquisitions when he believed the merger price was set too low. His strategy involved exploiting the spread between the current stock price and the price offered in such transactions, capitalizing on predictable corporate actions that would ultimately raise the stock's value. Third, special situations investing. Graham had a keen eye for special situations, including companies undergoing restructuring, bankruptcy, or asset sales. He saw opportunity in companies whose parts might be worth more than their whole, another value-based strategy that took advantage of temporary mispricing in the market. Fourth, contrarian investing and Mr. Market. Graham famously warned against following the crowd, which often leads to buying at the peak and selling at the trough. His concept of Mr. Market, the fictional, overly emotional character representing the stock market, symbolized the irrational fluctuations of market sentiment. Graham advised investors to take advantage of Mr. Market's swings by buying when prices were low and selling when prices were inflated, rather than succumbing to emotional decision-making. The legacy of the intelligent investor and Graham's enduring influence. Graham's autobiography would undoubtedly delve into the process behind writing The Intelligent Investor, his timeless guide to rational investing. Published in 1949, the book emphasized that investors must focus on safety and fundamental value rather than market sentiment and speculation. Warren Buffett, one of Graham's most famous students, once called The Intelligent Investor the best book on investing ever written. In his autobiography, Graham would likely discuss how his approach shaped not only his own career, but the practices of countless investors worldwide. His autobiography would also capture the personal side of his work, including his dedication to teaching at Columbia, where he influenced generations of investors with his patient, methodical approach to finance. Graham was not just a theoretician, but also a practitioner who believed in the power of clear, disciplined thinking applied to real-world problems. A life of financial wisdom and intellectual curiosity. Benjamin Graham's autobiography would provide an inspiring narrative of intellectual curiosity, resilience, and innovation. His theories went beyond the numbers, emphasizing the importance of emotional discipline, ethical behavior, and a long-term perspective in investing. His strategies remain as relevant today as they were decades ago, emphasizing a conservative, evidence-based approach that stands the test of time.